Hello and welcome to our Winkworth Shield webinar. I'm Blair Adams, I'm a partner in the employment team. This is my colleague Sophie Elwood, who's an associate in our corporate tax team. And today we're going to be looking at the off-payroll working rules and the changes that are coming into force in April 2020. We're going to take the approach of looking from the client's perspective. So if you're the end user and engaging a number of contractors, we're going to be looking at what this means for you. Now, we are aware that the government has recently announced a review of the implementation of these rules. It's a somewhat subtly worded announcement of the review, but the general consensus at the moment seems to be that the implementation will go ahead as planned, and the purpose of the review is to help businesses cope with the implementation. So for today's purposes, we're assuming that the changes will come into force as they have been published at the end of last year. From a client's perspective, this is a typical off-payroll structure. You, the client organisation, have an engagement with a contractor, but it's through an intermediary. Often that intermediary is a PSC, a personal service company, that's been set up by the contractor and is owned by them or perhaps them and their spouse, specifically to provide their services. In this structure, at the moment, the PAYE tax risk falls on the intermediary. So if it was found that the contractor was not genuinely self-employed, the responsibility would be on the intermediary to operate PAYE, to make income tax and NIC deductions. In most cases, the client is relatively untouched by risk, unless of course the intermediary is not good for the money. But Sophie's now going to explain how things are going to change from April.
Yeah, so the change coming in April is to really try to tackle widespread non-compliance with the current regime. But the change isn't completely new, rather it's an extension of the rules which already apply in the public sector. So those rules are being extended to medium and large organisations in the private sector. So small businesses engaging off-payroll workers won't be affected by the changes, and the current rules will continue to apply in those situations. Now, broadly speaking, the new rules will only affect organisations that engage with off-payroll workers and which meet at least two of the following tests. They have more than 50 employees, a turnover of more than 10.2 million, and balance sheet assets of more than 5.1 million. And the onus will be on these organisations to assess the tax status of the off-payroll workers that they engage with. So the idea is that this will reduce the number of cases of non-compliance with the off-payroll working rules and stop contractors with whom there is a genuine employment relationship from avoiding tax. So what's really happening here? Well, the new rules will shift some of the tax risks with off-payroll structures to the clients themselves. So instead of the individual contractor deciding whether they are employed or self-employed for tax purposes, that decision will have to be made by the client organisation. And in some cases, the client will then become responsible for deducting income tax under PAYE and paying NICs. So this means that client organisations will need to review all of their contractor relationships to decide whether any of their contractors engaged via an intermediary company are deemed employees for tax purposes. Now, they should do this in advance of the 6th of April for their current engagements, and then at the outset of every new contractor engagement thereafter. And they should also repeat that assessment on a yearly basis in case circumstances change. Now, in assessing a contractor's tax status, clients must take reasonable care in coming to their decision. The new rules do not permit you to simply adopt a blanket approach to all contractors, attractive as that might seem to minimise your risk. What you do have to do is look at and consider each individual relationship on its own, and you should be able to demonstrate that this was done with reasonable care. Now, once the client has come to a decision, it must issue a status determination notice to the contractor and to the intermediary company that it has the contracting relationship with. The contractor has a right to challenge the determination, and the client must consider their representations and respond in writing within 45 days, either giving reasons for sticking by their original decision or issuing a new status determination if they come to a different conclusion. So failure to respond to a contractor's representations will result in the client being treated as the deemed employer and therefore responsible for operating PAYE on fees paid to the contractor or the PSC. So how do clients go about assessing a contractor's tax status? Well, they'll need to consider in the round whether there is a deemed employment relationship with the contractor. So the types of factors that they should consider are whether the contractor is obliged to provide a personal service to the client, which would indicate they're an employee, or are they allowed to send a substitute worker sometimes? What are the payment arrangements and the contractor's time commitment? What degree of control can the client exercise over the contractor? So, can they decide when, where and how the tasks are to be performed? Does the contractor use and provide their own equipment? And do they take on any financial risk or have the opportunity to make profit? And also, how far is the contractor integrated into the client's workforce? Do they enjoy the regular employee type benefits, for example? Now, none of these factors are decisive on their own, so clients need to consider that relationship as a whole. HMRC have a newly enhanced online tool to check employment status for tax, and that's a really good starting point, although it might not give the right result in more complex cases. But Blair's going to look at the possible status determinations and what they
Thanks,
mean.
Sophie. I mean, you've covered a lot of ground there, and I think it's probably worth reiterating exactly what's happening here. So, as a client entity, as the engager of individual contractors, you are going to be responsible for assessing their tax status. And if you follow the way that the courts and tribunals and the tax tribunals have struggled with that very issue of deciding who's an employee and who isn't, you'll realise that's a very challenging task. And you've been given almost no resources with which to do it, apart from HMRC's online CEST tool. CEST has come in for a lot of criticism. An enhanced version was launched a couple of weeks ago. I think the jury's out on whether it really makes a difference. But you are being asked to do a very difficult task with very little available to you apart from what your advisors can offer. If you take on that task, you can make only two determinations in this process. The first would be that the individual contractor is self-employed for tax purposes. Now, if that's your conclusion, your determination, then your intermediary relationship can continue. You will continue to pay gross, you won't make PAYE deductions, and the status quo will continue. In other words, the tax risk will fall largely on the intermediary and then the contractor. If, however, you decide that looking at this relationship in the round, taking into account all the factors that Sophie's mentioned, this is really a deemed employment relationship. So in other words, if you remove the intermediary from the structure, the relationship between you and the individual is really like an employment relationship, then you've got to make changes. Firstly, you, the client, as the fee payer under this legislation, will be responsible for making what's called the deemed employment payment. Now that's very broadly about 95% of the fee you're currently paying to the contractor, but the formula for calculating it is set out in the tax legislation. And on that you must operate PAYE, as you would with anyone else on your payroll. Then you've got to consider how you go forward. Do you continue in an intermediary relationship, or do you bring the individual onto the payroll? I think there's a divergence of opinions on this point at the moment. Some advisors would say you can carry on with the intermediary relationship. My personal view is that's not really consistent with the purpose of the legislation. It also gives rise to other difficulties, which as an employment lawyer, I would see as how do you categorise this individual? You've decided that they're not self-employed for tax purposes, which implicitly means they must either be a worker or an employee within your workforce. They'll therefore have certain legal rights, depending on which status they can lay claim to. And it will probably be simpler to bring them into the workforce openly on the payroll in one of those categories. Which category you decide to give them will be largely determined by how you've, the conclusion you've arrived at following the process that Sophie outlined a minute ago. So let's just think for a moment about slightly more complex of payroll structures. So in this structure, there's an additional layer. There's you as the client, there's an intermediary, and then there's the PSC and the contractor. Now that extra intermediary could be any sort of entity. It could be an employment business, could be an umbrella company. But that does make a potential difference in this scenario, because the way the legislation works is that when the client issues its determination notice to the intermediary, it has the effect of passing on the tax risk to that intermediary. This only works where the next person in the chain below you as the client is firstly a non-offshore entity, so it must be a UK registered entity, and secondly, it's not controlled by the individual contractor or their connected persons. If you remember, most PSCs are owned by the contractor and maybe their spouse has a shareholding. If that's the case, this would not work. But if you have a non-connected entity in the chain, then you can pass on the tax risk. Now that's fairly convenient for you as a client. Couple of things to be thinking about there, however. It only really works if the entity you're passing it on to has substance and is good for the tax. If it's going to disappear overnight, then you will be deemed to be the fee payer again, and the tax risk will fall back on you. And secondly, I think some of the professional intermediaries in this space may look for the opportunity to have contractual provisions that effectively pass the tax liability back to you as the client through indemnities and things like that. So again, you need to be careful about whether you're really achieving what you designed, or what you're setting out to achieve.
I think the key action for clients affected by the new rules is to start by analysing each of their contractor relationships to consider, who operates through an intermediary, which entity is the fee payer, and really understand how those relationships fit into this regime, and where the responsibilities lie. The next step will be to analyse whether there is a deemed employment relationship with a contractor, so using the CES tool and seeking advice in more nuanced situations, and then issue the status determination. Now, in advance of the changes in April, we suggest clients should identify key contractors who are critical to their business and sort of discuss the process with them so that they can manage that relationship appropriately. In some cases, the client status determination might not line up with what the contractor expected and their own views. So it's probably better to have an open dialogue now rather than simply issue an unwelcome or unexpected status determination in April. And we think larger organisations which do use contractors regularly should make sure they put a policy in place so that they can ensure that they are able to demonstrate they meet their obligations under these new rules. So in particular, they should have records showing the reasonable care they took in assessing employment status, and that they responded to contractor representations within the 45-day time frame. And clients can also use that written policy to ensure that they have a defence in respect of the corporate offence of failing to prevent the facilitation of tax evasion, which could kick in here in very serious tax evasion scenarios with the contractor or intermediary.
So what we've been doing with clients in the run-up to this, and I don't think it's too late to approach this problem, is firstly helping them with managing the individual relationships, as Sophie mentioned, but also putting in place a kind of compliance toolkit so that there is a procedure for making determinations, which gives you a paper trail showing what you're taking into account in each case. And I think that's very important, particularly in large organisations where lots of contractors are being used, perhaps on a fairly ad hoc basis. You will need to demonstrate some consistency here of approach. We also advise on specific cases as well. We help clients formulate the wording of a status determination and the reasons in response. And of course, we help with the adjustments to make in cases where you find there's deemed employment, either before the 6th of April or after the 6th of April. and we will advise on ongoing checks, the annual checks that Sophie mentioned, just to make sure you are compliant and thorough in the way you're approaching this change. So that's all from us today. Thank you very much for watching, and if you have any questions or would like to discuss any of this, our contact details are on the screen. Thank you.
Thank you.